Hey everyone, it's Daniel here from Infovest. Hope you're all doing well. Just wanted to talk about an interesting article here, and I'll post it in the description below. The article basically says private mortgage lender bust begins as loan application crash, right? So we're starting to see a lot of private lenders out there, a lot of private mortgage companies out there starting to go bust. And since the rise of the federal funds rate in the U.S., as interest rates started to continue to increase, we start to see bond yields, especially the long end of the bond yield, the 30-year yield, start to rise and pick up as well, which fed into the mortgage rates, the long end, mortgage rates being tied with the long end, which is why we've seen mortgage rates basically in the US go from 3.27% to as high as 6% in mid-June. Now it's come off a little bit here, but if you look at the 30-year bond, especially today, it still continues to sell off in terms of its prices, right? So I'm just going to quickly here look at the 30-year bond. Yeah, so if we look at the 30-year bond today, it has come off. And if you look at the 30-year yield, of course, bond prices are inversely related to yields. The 30-year yield right now, as I speak, is 3.21%. So if you look at the chart and if you pull it up, the ticker on TradingView, if you're using TradingView, just type in US 30Y, and with that ticker you could see the 30-year yield, the US 30-year yield. I'm talking about the US bonds here. So the US 30-year yield is picking up to 3.21%. It has broke that resistance, which has been in place since around June up until August, and now we're seeing a trend where it's picking up, right? So that tells you that yields are picking up, and if yields continue to pick up on the 30-year bond, that's going to trickle into those mortgage rates that a lot of consumers might be feeling the pinch on, and if we break above the highs of about 3.48 estimate, right, on the 30-year yield, then that will start to approach close to that 3.5, or even we could see yields continue to rise up to maybe 4%, especially if the Fed decides to continue to raise rates more aggressively, and if they start to do quantitative tightening, which is the selling of bonds, and they start to actively do that. Now we know in September they're going to pick up the QT in the balance sheet process, and not only they're going to do that, but there's even talks about possibly selling off bonds off their balance sheet, which is more aggressive than usual, which would basically mean that the yields on the long end, by selling bonds, like we said, prices are inversely related to yields. The yields on the 30-year bond is going to continue to move up while they sell off those bonds off the balance sheet. Now, they haven't confirmed that, but there are talks, and there has been talks of this previously with a lot of the Fed members out there, right? So it'll be very interesting to see coming up in the Jackson Hole meeting that we have, and we're going to hear next week. The Fed's going to come out and basically a lot of other central bankers are going to meet in Jackson, Wyoming, and they're going to talk about monetary policy there. We might hear the Fed talk about his views, or the committee's views on the interest rates. Now, right now, in the equity markets, we've been seeing a rally, and if you look at S&P 500, it's rallied about 18%. You look at NASDAQ, it's went up about 24% since the bottom of June. And today we had some selling pressure today in the equity markets, and we see yields on the 30-year bond move up as well. And we are close to hearing if we're actually going to hear a pivot or get a pivot from the Fed, and that's why we've been seeing this rally since June, is because the market's been pricing in that the Fed's might start pivoting, the Fed might slow down its rate hikes, Fed's not going to be as aggressive, Fed's going to probably start cutting rates next year, or not even reach to the 3.5 or 4% or 3.75% interest rate. And starting September, probably we're going to get a 50 basis point rate hike and then ease up from there. That's what the market's thinking, right? Now, the Fed and a lot of the Fed members have come out and bargained and so on. They've come out and they said, we're not calling this a victory. We're not calling that, even though CPI report came in weaker than expected last month, but we're not calling it a victory because we have seen inflation in 2021 where inflation has come down in the summer months and then picked back up. So could we see the same scenario here, right? We still have geopolitical risk. We still have geopolitical tensions. Russia, Ukraine, we still have also the issue with the supply chain issues and China's zero COVID policy, and plus on top of that, to add more troubles and more issues, the tension between China and Taiwan and US to add into that. So there's still supply chain issues that can feed into inflation, that could push inflation higher, which could cause the Fed to continue to raise rates aggressively, right? So we will get more of a better picture next week when we hear from Fed. We'll get more of a better picture in September when we get the jobs data and when we get the next CPI report. And we'll have a better, clear idea and a picture, hopefully, by the end of September when we get the next FOMC meeting. And in the next FOMC meeting, we might hear the Fed come out and maybe talk about the past inflation reports and talk about its plan for its rate hike cycle. Now, even if they slow down their rate hike cycle, doesn't mean they're going to slow down the balance sheet runoff or the tightening on the balance sheet, right? So they could do a transition where, sure, they may continue to still raise rates and maybe raise rates by 25 basis points and onwards, and maybe not do it as aggressively as 50 basis points or 75 basis points or so on. And they may lead towards maybe actively selling bonds off their balance sheet, which is, again, another form of tightening, which does tighten conditions, which does cause yields on the long end to move up. And it's another form of raising rates, which will cause pressure. Right? And in this article, which it talked about these private mortgage lenders, a lot of them, a lot of them have seen huge mortgage application volumes basically drop to levels that not have been seen since 2000, since the dot-com bubble implosion, right? So the number of people applying for a mortgage, the levels have dropped back to 2000. And a lot of these mortgage companies, if I were to name a few here, from this article, Sprout Mortgage is another one that is basically laying off employees. We have another one, Loan Depot, which laid off about 4,800 jobs because just simply the mortgage volume and the applications dried up. And then we had another one, First Guarantee, which filed for bankruptcy. Now, banks have came out, the traditional banks, and obviously they are more prepped for this scenario here. But they came out and they said that they're not going to be affected. Now, of course, their lending practice or the lending side of the business might see, a drop there. But in terms of bankruptcy for the banks, it's, you're not going to see that scenario. You'll see it more with the private lenders who are taking on more risk or depend on the mortgage applications to come in. So especially with the rate hike cycle, especially with the aggressiveness from the Fed that we have been seeing in the past since this year, definitely those are the reasons why you could see these mortgage brokers starting to go bust or firing employees, a lot of them, to save up on their cost. And, it makes me think, if we continue to go on this rate hike cycle and we continue to raise rates aggressively, and how will that look like for a lot of other companies out there? We heard layoffs from other companies and retail companies, and Tesla and Walmart, and a lot of these companies coming out projecting grim future earnings, right? And they're doing that now. How is that going to look like 6 months from now when rates are in restrictive territory, right? Before that, we weren't in restrictive territory. We're going to get restrictive territory. We're going to hit 3% by the time we get to September. And the effects of restrictive territory area, right? We're going to see the effects of that probably in 6 months from then. And we'll probably see also rates will continue to move up higher into restrictive areas, stay in that area, probably next year of January, February, March. We'll probably see the effects of that. And you might hear more articles like this one where you'll hear more mortgage brokers going bust, more companies going bust, startups going bust, a lot of companies who are cash dry going bust, a lot of companies who have a lot of debt going bust, right? More also on the crypto markets and crypto companies having more issues when it comes to their sustainability. And also it will trickle down into the banks. I'm not saying the banks are going to go bust, but you're also going to see lower profit margins and also a squeeze and a tightening in terms of banking, because now if you have higher rates and you can't really lend it out and you're not making money from short-term rates and you're not making money off lending, or you're not making much money off of lending, then that's also going to dry up the earnings for a lot of these banks, and which is going to also lead towards job losses. And that's when you might start seeing the non-farm payrolls report, the jobs data report start to come in weaker. So we still got some time. We still got a lot of, more to keep an eye on in terms of the Fed communication, what the Fed wants to do. From the looks of it, it looks like that the Fed wants to continue on its rate hike cycle and continue with quantitative tightening. And, more stories like this of companies going bust, we might see it more and more as we approach December, as we approach January. And on top of that, to add more fuel to the fire, the geopolitical tensions that we're seeing with Russia, Ukraine, China, Taiwan, US, and etc. and etc. So let me know what you guys think. Leave a comment below, and I'll see you guys around. Thanks. Bye. And follow for more. And I keep forgetting to mention this. Subscribe and follow if you'd like to hear more on these topics about the market news and the stock market and where the economy might be heading in a couple of months. So I'll see you guys around, and cheers. Goodbye.